All right, we are live. Hey, I'm Mitch Goldberg. It's time for Be the Boss of Your Money. You know, when it hits 4:30, we get the show started. Well, about 4:30, a little after 4:30. You know, these are busy days. There's a lot going on. A lot of phone calls to field, a lot of people to speak with, a lot of information gathering. I do spend a good amount of time speaking with other professionals in the industry who are not financial advisors, people involved in different aspects of trading in the world of finance, and you really want to get a good grip of what's going on. Could we be like nearing could we be nearing the end of the sell-off? Could it be that inflation has run its course and or is about to peak and the Fed maybe doesn't have to get as aggressive as we thought? You know, this is the hope, right? That's the hope that we hang our hat on, and that's when when the market comes back, financial media pulls out a host of people saying, "Oh yeah, we knew inflation was about to peak. We knew it would be so bad. We knew the Fed couldn't be so aggressive." And then the market goes down a lot. And there's a parade of people who say, "Oh yeah, Fed's got to be really aggressive. Inflation's going to be like this for years. We're never going to get back to where we were with the supply chain issues in 2019, and it's just going to be awful. And the Fed's got to jack up interest rates and send us straight into, a Paul Volcker style, interest rate induced recession, and it's going to be really bad. Something's got to break, and something's got to give." I don't know. I mean, but these are the two extremes of where we are right now, and there are so many opinions. Paul Tudor Jones, one of the most famous, well-regarded, well-renowned investors in the world, says this is an awful time to own stocks and bonds. You should be in cash. You should not. Your preservation's the name of the game. And then Rick Reeder from BlackRock is like, I think we could be bottoming. I think inflation could be peaking. I think the Fed raises rates. Everybody understands what the Fed's going to do, and we're used to it, and we go back up. And if we have a quick sudden rally, then those people will look right. If the rally peters out quickly, nobody's going to remember, and we'll go back to talking about how bad things are. And nobody can make up their freaking mind. How about this? Just hear me out on this. How about we don't know what comes next, and part of investing is having a little bit or a lot of bit of blind faith in in expecting, hoping that managements of corporations will get their act together, adapt to whatever changes in the world that they need to adapt to, and then we'll march forward. Stocks will go up, interest rates will do what they do, and we'll be okay. But this constant need to know if we're going into a recession or not at the end of this year or sometime in 2023 or 24, this constant obsession to try to figure out if corporate earnings have peaked or they're going to go down, or if inflation has peaked or it's going to continue to stay high and maybe even go higher. This constant obsession about what Jerome Powell is going to do next, when Jerome Powell probably doesn't even know what he's going to do next. It's really getting to be a little tiresome. I think people need to focus on other things, because this is all banter. This is what, to me, it's fun. I mean, don't get me wrong. I like to talk about this stuff. But when it becomes an obsession and it's something that could throw you off your goals or make you make sudden changes to your investment allocation or your financial plans, it starts to become it starts to hurt more than it helps. Well, we're live. That kind of sucks. I hate when that happens. I don't know. This happens like 2 or 3 times a month between 4:30 and 5 o'clock. We lose internet access, and it's just only those that time of the day. And when you call the cable company, by the time I get around to calling them, the show's over. It's 5:30, and it's pretty much the day's shot. It's very upsetting. Anyway, we were talking about the constant obsession about trying to figure out what's happening in the near term with the economy, with the stock market, interest rate policy, Federal Reserve policy. So now we're going to roll the intro, and we're going to have a quick show. We're going to go over a couple things in the market today, a couple things you should take a look at. We looked at the 30-year mortgage rate today. We're going to look at it again. I think that's something we'll have to take a look at every single day, along with other interest rates. So here we go with the intro. Thanks so much for sticking with me during that quick little blackout, and many thanks. All right, there goes the intro, and hopefully somebody out there is watching. Man, oh man, that is just so upsetting when that happens. But hopefully we'll get a good snippet out of it, right, Natalie? Um, mm. All right, look, it's not the end of the world. I do this for fun. I enjoy doing it. Let's not take it too seriously. It's not a big deal. I've got more important things to do in my day anyway. Spoke to a bunch of clients today. Took care of a Roth conversion today for me. Bought a couple of stocks yesterday. Um, yeah, left messages, sent emails, replied to emails. I had a pretty busy day. Took care of some paperwork for a client. It's one of those things. Anyway, let's get rolling. So let's take a quick look. By the way, I'm on Instagram, Client First, Strategy for YouTube, LinkedIn, Facebook, Twitter, wherever you enjoy following your social media. Rhonda is out there. Hey, Rhonda. Hey, nice to see you, Rhonda. I feel like I haven't seen you in ages. So nice to see you as well. And you're my fellow Long Islander. So one of these days we actually have to we have to put together a luncheon. I'm gonna have to put together like Mitch's favorite be the boss of your money people, of which you are you're number one, Rhonda. You. All right. So we have to do that. It's good to have you here. Let's do a share screen. Okay. I'm here. Let's take this off. Okay. So not a bad day. Let me tell you why I think today was a really good day in the market. Why today is a day that could be celebrated. And you might be thinking what is Mitch talking about? The Dow is only up 67 points, which is nothing, right? NASDAQ is only up 27 points, which is, zilch, basically nothing. S&P 500 was only up 20 points, hardly anything. Gold was up $3, big deal on a $1,867 commodity. The 10-year yield barely was down 2.5 basis points. The VIX was off a little bit. Okay, that's a good thing. So a little fear coming out of the market. But basically the major averages, oil was off a little bit. Gold, nothing really moved today. So this was, to me, a really good day. And you might be thinking, well, why was it a really bad day? Wouldn't the Dow have to be up like a lot for a good day? Like today was a great day. I'm telling you, it was a very good day. And again, the Dow was not up 1,000 points. And that's why, you might be thinking, well, why would that be bad if the Dow was 1,000 points? I don't like these days where we have gigantic up days after big down periods, after big down swings. Because if you have a really big up day, it just gets repealed the next day. Then we have another down day, or maybe the day after that, it'll just get repealed. I don't want the giant volatility. I don't get excited when we have a big rebound after a horrendous couple of weeks. What I get excited about is when the market starts to find its footing. It starts to find equilibrium between buyers and sellers. We start to figure out, well, what is the value of a corporation? Because let's say a stock is $100 a share. So we're valuing that corporation at $100 a share. Then the stock is 110, it's 90, it's 88, it's 112, back and forth. These are big swings. And why would, let's say, a $100 billion company be worth 10% more or less on a day-to-day basis when you can't change the fundamentals or anything about that company that quickly? Now, I do realize, yes, there's earnings surprises. And sometimes people, investors beat down a stock too hard. The company surprises with earnings and revenues, and investors say, wow, we beat them up too much. The stock has to have a quick rebound. And then we find a little bit of equilibrium. That's why I like today. That's why today I think was such a good day, because we were only up a little bit. If the Dow was up, I'm just looking at the screen, was up. The Dow was up 67 points. If it was up 670 points, we know we're in for like another really, really bad day. And that is what I'm trying to point out. I like a good flat day where we finally start to find our equilibrium, our bearings. Does that make sense to you? That's why I think it's a good day out there. Okay. Oh, Wanda says, "Oh, so sweet." That is sweet. Thank you. Um, so let's keep going. Let's keep looking at what's out there. Let's look at interest rate. Interest rates were pretty much up on the short end, right? 5 years and under, and they were down on the long end. And that's a little significant of normalization. That means they're up on the short end. Okay, you see like half are green and half are red. Okay. They're up on the short end because tomorrow is Fed Day announcement. Tomorrow. Okay. May 4th. By the way, tomorrow's May 4th. So maybe I'll wear like a Star Wars shirt or something, but May the 4th be with you is tomorrow. So this is reflective that the Fed is expected, highly anticipated, that the Fed will raise rates 0.5% tomorrow. You'll see the announcement. So that affects short-term rates more than it affects the long-term rates. So long-term rates are expected to go up, up. This is the international sign language for up. Actually, I just made that up. Whoop, whoop. I'm getting goofy. I'm like starving. My blood sugar is like rock bottom low right now. Uh, so, but the long end bonds are up, yields are down, the opposite of the short term yields, which all went up across the board today. Long ones went down. Why? What gives? Why did the 20-year, the 30-year, the 10-year? Okay. What gives is this. There is an expectation in some corners of the market that inflation is peaking. That maybe we don't need to be as worried as we thought about more inflation. We're not giving back the price gains probably that we've seen in the last 6 months, but at least they could stop going up or go up a lot slower. So the expectation is long rates are down a little bit because they're showing expectation of a slightly slowing economy and an easing up of inflation. Short rates are up because the Fed's going to raise interest rates. That's what it's showing you. And that means the yield curve, the difference between long-term rates and short-term rates is compressing a little bit. And that also tells you that the economy is expected to slow down a little bit. Now, we're not at an inverted yield curve like we were, let's say a month and a half ago, but that's the story. That's the message in the market. But these moves are so slight. You really need to see if they keep building up. Does it change? Does it change how you invest? For some of you, yes. For some of you, it does change a little bit how you might invest. For most of you, no. Okay. Let's take a look at crypto. Crypto keeps going down. I feel like this crypto is in such a weak place. And, the NASDAQ was up today. Usually crypto follows the NASDAQ, but on steroids. So it's got a higher beta, meaning let's say for example the beta of the Nasdaq is 1. So if the Nasdaq goes up 1%, you'd expect Bitcoin to go up 2 or 3%. If the Nasdaq goes down 1%, you'd expect Bitcoin to go down maybe 2 or 3%. Okay, high beta. Bitcoin is super high beta, but it just seems to be giving back a little, giving back a little, giving back a little. It couldn't hold 40,000. So you have to wonder what's going on. And always have to look at the joke of a uh, Dogecoin. Wow, Doge is down to 13 cents. All those people who went out and bought it because Elon Musk said he liked it on Saturday Night Live, right? Went up to 75 cents. It's like a $75 stock going to 13, right? Disaster. Let's take a look at the watch list. This is what I want to show you. This is the 30-year mortgage. It was down ever so slight. So still, a little bit over 5.5%. Okay. These are some bond funds that I look at, like MIR, the iShares Short Maturity Municipal Bond Fund. It's down, but from a little over 50 to a little under 50. It's a very low volatile type of product. Let's keep going. BlackRock's Rick Reeder says the Fed could spark a relief rally and the market sell-off could be nearing an end. Now, I remember hearing Tom Lee from FundStrat saying we've bottomed and we hit a lower bottom. Not a much lower bottom, okay, but a little bit more of a bottom. So it's really tough to know if we are going to make a new bottom, a new low, or not. But this is what we're talking about. So anyway, Scott, disaster. Thank you, Con. That's funny. Disaster. LOL. Yes, you are correct. Disaster. Thank you, buddy, for being here. I don't know if I haven't seen you here for a long time, Colin. It's nice to see you. Just want to show this also, Scott. Hey, Mitch, great seeing you last week. Good commentary. Hey, Scott, it was great to see you and your wife last week as well. It's only Tuesday. That was only a couple of days ago. It feels like a month ago already. I haven't seen you since Chris and Tony's, right? Over the summer. That was a nice night that night. I will remember that night. It was a good night. Anyway, so Rick Reeder, BlackRock says relief rally. I could see it. I could actually it's easier for me to envision an up market right now, a rally, than more of a down market. I think the sellers look exhausted. And again, we had a flattish market today, slightly up, which is what we want. I don't want a gigantic up market. I want a gigantic up market. I want a market that just goes up a little, something that we could build upon to say we've reached an equilibrium. Let's take a look at some of the big numbers after hours. Advanced Micro Devices up over $5, up over almost 6% aftermarket trading, decent numbers. Starbucks, which is at a low, and Starbucks, from what I understand, is below its 200 moving day average for like the first time since 2020, right at the beginning of the pandemic, and the time before that was 2009, at the peak of the bear market from the Great Recession. And Airbnb is up a couple of bucks. Don't kid yourself. Airbnb up $5.44. It was down like $6 during the regular trading. So I don't think it hasn't even made up. Oh, there it is. The close. It was down. See this? It was down $8. So it hasn't even made up for its losses of the day. So a little bit of a pop, but nothing to write home about. Anyway, that's the story for today. We talk about the market. We talk about money. A couple of things you should be doing that you should consider. And I don't want this to be blanket advice. This is for some of you. The conditions for some of you might be right for a Roth conversion. If you have a traditional IRA, the account is down a lot. You could convert that to a Roth. Remember, when you convert your IRA to a Roth IRA, whatever amount that goes out of your IRA into the Roth IRA, whatever that amount is, that dollar amount, you have to pay taxes on it based on your income tax. Okay, income tax rate. So your income taxes on it. But if your IRA has gone down a lot, a lower dollar amount means you pay a lower dollar amount in taxes. So when the market's down, that's a time you want to take advantage of. You want to explore taking advantage of a Roth IRA. Explore the potential to see if it's right for you. because this is about personal finance, not blanket financial advice, right? We put the personal back into personal finance. Make personal finance personal again. I just have like a whole idea for a hat and a shirt right now. Stay tuned. So also, if like you expect that this year is going to be a lower income year, or you're going to have, just for whatever reason, a low income this year, you're going to be in a lower tax bracket maybe, that's also a reason to consider a Roth conversion, converting all or some of your traditional IRA into a Roth IRA. So these are the kinds of things that we need to explore, because it's not just about investing, because once you get your investment set, your asset allocation, how much you have in stocks, bonds, cash, large cap stocks, small cap stocks, medium stocks, mid caps, international. Once you get that in a groove that's appropriate for your risk tolerance, there's really not a whole hell of a lot for you to do with it. So the next thing you want to do is focus on how you could be as tax efficient as possible over the long term. Converting an IRA to a traditional IRA to a Roth IRA creates a tax right away. So is that efficient right away? No. But long term, could that be efficient? It could be, because it could save you a lot more in taxes down the road than what you're paying today. All right. That's my story. I'm sticking with it. I will see you guys tomorrow. If you have any questions, words of wisdom, words of encouragement in the comments, definitely hit me up over there. I will see those. Thank you so much for watching, and always a pleasure.